Are you ready?
Ready.
All right, let's go. Kevin here, Top 1 Financial Advisor and best-selling author. We are here to talk about the stock market. And here we are. The stock market is down. We are actually right back where we were in March of 2021. It's not fun. Everything, it feels like, is red. Everybody is losing money left and right. And this is a point of struggle. It's a point of contention for a lot of new investors, but just investors across the board. So let's quickly discuss what you should be paying attention to right now, what you should be concerned about, and what you should not be concerned about. So to boil everything down, I think you have three choices. Three choices, and that's it. You only got three. Choice number one is you can continue to buy what I would think are quality companies, and I'll talk a little bit about what I mean exactly by that. So one, you can continue buying quality companies. Y'all know what I do every Friday, right? I go through, see what I like, and I continue buying what I got in my public profile. My 401k, all that stuff is already automatic. Every 2 weeks it comes out and it buys what it buys, okay? So that's it. And I'm going to continue to do that. I don't care what's happening. Recession, whether it happens or not, market falls all the way back to, I don't know, 2008. I'm doing the exact same thing. I don't think that's going to happen, but that's just my example, okay? I'm going to keep doing the process because we know research has shown us, recent history has also shown us that those who can stay consistent and continue to buy even when the market is not fun, even when the market is not going the way you want it to, that can still be helpful, okay? That can still set you up for the future. So that's number one. That's probably the best choice of the three. The second one is you can actually make money as the market goes down. That is a thing. In fact, I did an option contract, a put option contract, which basically says that I get to sell at a certain point, and as the stock continues to drop, my contract is worth more. And I did one on Revvion this morning, made my money, got right up out of that, right? And this is one way that while I can continue to buy my long-term stocks, I can buy certain option contracts and make money as the market falls, and that's fine. So I can make money whether the market is up or down, and you can too. That is an option for you. Now, it is a little bit more advanced. If you are someone who just started investing in the last 2 years or so, I do not recommend it for you unless you have the proper education and training for it. I do teach those things, but I usually say, look, you need to understand how the basics of the stock market works before you move to more advanced stuff like options contracts. But it is a thing, and it can work, especially when the market is down. I mean, imagine, and we'll talk a little bit about SoFi later, but things like SoFi and Revvion and Netflix and PayPal and Square and all the companies that we know have been absolutely awful and have been down 60, 70, 80%, they're going to continue to be down for the most part. So you can make money as they continue to fall. So that is one thing that you can do. Then the third thing that you can obviously do is panic and cry and run for the hills. You can do that. I don't think that's the best thing for you to do, but people have done it, and that is an option for you. I don't think it's a good one, but it is there. So those are your three options. You continue to buy quality, you can do options contracts if you're a little more advanced, or you can cry and run for the hills. Now, while crying and running for the hills is the thing that we all feel, right, that's not the best thing for you to do. I want you to approach the market like this. Now, I've said for the better part of maybe a month, maybe even 2 months at this point in time, that you've got to look for value, you've got to look for defensive stocks. And sometimes these things do tend to overlap, and you want to look for quality. So I want you to imagine right now, you are the largest company, maybe you're CEO, or you work there or whatever, or you own shares of it. Let's say you own shares of what is one of the largest, most valuable companies in the world. Okay, you have some of the best products out there. Your company is not shrinking. You're not shrinking. You are not, people are still buying your product. They're not running away from your product. And in addition to that, you've grown a little bit modestly, so you're still growing, and you have $21 billion in cash to do whatever it is you need to do. Okay, you're sitting on $21 billion with a B. You're one of the largest companies in the world. You're still growing. People still love your product. They're not going anywhere. That company is something like Apple. Apple is down, but they got $21 billion in cash. That, to me, screams value. It does. It's down. You got money. Apple is not broke by any stretch of the imagination. People are still using their products. That's value. That screams value right now. It is unfairly punished, if you will. It's down, and it really don't have to be. And based on what we know about Apple and how they've done in the past, but also what they look like as a company, they have money, they're still growing, that tells me that, hey, look, you're down however much Apple is down and it shouldn't be. I'm going to go on and buy me some right here. And I'm going to hold on for the long term. Another company that I like is United Healthcare. They are, you know, depending on what time frame you're looking at, they can be down, they can be up, but they're in a space where you're the 6th or 7th largest company in the United States in terms of market cap. Like, so when we talk about all these index funds are one of the biggest in terms of market cap. You're in a space where people have to have it. You have to have health insurance. It is a thing, and that's not shrinking. No one is saying, hey, I don't want health insurance at all and not using United Healthcare. That's not a thing. People are still using it. It is a consistent business, and they have $25 billion in cash. They're going to be fine. That, to me, screams value. Okay, another company that we've talked about before is Berkshire Hathaway. It's one of the few companies that is green right now. They spent $51 billion, and they still have $39 billion with the B. I think that's value, right? I look at it, right? So not every company's in that position, and I think that is the key where some people are struggling, where you have companies that, you know, I'm totally comfortable with. Like, I have not sweated not once this entire time as the market has been down, because the vast majority, not all, is one I'm gonna get rid of. It's one, at least one I'm gonna get rid of. But so far, all the companies that I have still have a lot of these aspects. They're growing, or at least they're solid. If not growing, they're keeping pace with everything. They've got cash on hand. They are fine, right? That's fine. Unless you don't have those companies and you don't know which ones are solid and which ones are not. So, for example, on paper, SoFi is one of those that I like the concept of SoFi, I like the personality, I like their products, but they only have $786 million in cash. That's not a whole lot. That's not for a company. That is not a whole lot. For contrast, and I know these are not exact comparisons, but for comparison, again, I told you Apple got 20 billion, right? Uber, as of the most recent quarter, they got 5 billion. Now, it's not to say that Uber is that much better, but you don't even have $1 billion in cash, and to make matters worse, you are a tech company. Tech companies are falling off the map, and most financial companies are also falling off the map. And these things just don't mix well together, right? They just don't right now. But then the other part of it is they're also not profitable, and they are not expected to make a profit until 2024. What does that mean? Right now it's 2022. You're losing money now. You're expected to lose money for the next 2 years. Okay, you're expected to lose money for the next 2 years. You only got $786 in the bank. And the cost of you borrowing, because if you're not making money, you got to get the money from somewhere. You got to borrow. That cost is going up. Therefore, if I'm an investor, right, and the market is looking at this stuff, you got tech, finance, fintech, both down so far this year by a lot, right? And I see like, oh, you don't have that much money in cash? Oh, you have to borrow a whole lot of money? And that the cost of that's going to continue to go up? No, man, I'm letting that go. Right, that is one of the reasons why it's down. I'm guessing here at least 70%. I want you to go and look it up and confirm whether or not SoFi is down 70% in the last year. I would be shocked if I were wrong. It's got to be in that neighborhood, because most companies in their exact same position are in that space. Very, very, very rarely so far this year are you going to find a company who has money, that is growing, that has cash in the bank, and is also down by that degree. Now, there are a lot of companies that are down 10, 15%, and they're fine, right? They're fine, but the market's just overly pessimistic. But you're down 50, 60, 70, that tells me that you got some fundamentals that aren't right. And that, as an investor, you got to decide, is this something you believe in for the next 5 years? Because 2, for SoFi, in SoFi's case, 2, to get profitability, assuming they're right. And then 3, to hopefully dig out of the 70 point decline, 70% decline, right? That's not going to be easy to get out of within a year, especially if rates are going to continue to go up in 2023. We'll see, right? But these are the things that you want to consider, and that's what helps me to decide whether or not I can be okay with some of the losses that I'm seeing. I'm fine. Microsoft is down. Apple is down. Danaher is down. A lot of the stocks that we all have, a lot more down. But number one, if I look this year, they're down. But if I look at, well, I've been holding this one since 2020. I've been holding another one since 2015. I might actually still be up. So that's another way to look at it too. Take a step back. Look at the stocks that you have. You can't just blindly invest in stuff without understanding the underlying things. Why we do these types of videos Monday through Friday, right? It's why we talk about them, to help you to have a better understanding of what's going on and to help you better react to some of these things. If you have an Apple, if you have something like a United Healthcare, something like a Coca-Cola, something like a Berkshire Hathaway, I'm fine. They're not going nowhere. Something like a SoFi, maybe in a firm, I might be feeling a little bit different. These are the situations that you need to decide for yourself how you want to feel, because the ones that don't have cash, the ones that aren't making money, those are the ones that are getting punished the absolute most. Whereas those that have money, they're fine. Those that have a customer base and they're pretty well established, those are the ones that are fine and going to continue to be fine, at least for the foreseeable future. So like next 6 months or so, those are going to be fine. They're good. They got cash. Worst case scenario, they can just use the money they have in the bank. That's what Berkshire Hathaway did, right? And they took advantage of some of the things that are going on, whereas others are not. So you do want to be careful there. But you got 3 choices. You can continue to buy quality, you can make money when the market is down, or you can run for the hills. I think running for the hills is probably the worst of the 3. All right, so if you want to support the channel, make sure that you go to the Investors Toolkit. That's buildingbread.com/tools. It is my premier course that I help you to understand how the stock market works and help you invest using my 7-step process. It's really, really easy to follow. And we also have a bonus section that talks about how to make money when the market is down like this. So I can buy and hold my long-term stuff. That's fine, but it's hard to watch all that red, right? So while you're doing that, you can also make money as the stock market is falling, and that can help you to offset some of what you're seeing in your portfolio right now. So you do want to check it out. One of my favorite bonuses in the course is, number 1, I give you my watch list every single month. It does not expire. But I also, for those who sign up for the bonuses, you are also able to sign up for a group call that I do every single month. We talk about what's going on. I answer questions live just like this. And well, usually camera's not on depending on how we feel on the day, but we do a live call every single month. People have been on these calls for like years now, where we talk about what's going on, what works, what doesn't, what do we need to add to the course, so on and so forth. So you might want to check that out, especially in a time like this. There's also a discount code. I think it's 15%, but that discount code will be in the comment section below, so you definitely want to check that out. That code does expire on Thursday, though. It does expire on Thursday. So if you like the content in the channel, you are going to love the course, so make sure that you check it out. All right, that is it for me. I'll talk to you later. Bye.